So now kind of move ahead to the 1920s. One by one, countries had to rejoin the gold standard. Gold standard was voluntary. There was no IMF, International Monetary Fund, at the time. But that left them with a big decision, which is, what is the new exchange rate? There had been a pre-World War I, pre-1914 exchange rate. Each currency was pegged to gold at whatever that government chose. And they would obviously try to do something that made commercial and economic sense. But you joined voluntarily and you picked your own exchange standards, so to speak. Of course, once you pegged to gold, you pegged every other currency in the world, because not everywhere, but all the major trading currencies, because they're pegged to gold also. And France and Belgium and Italy and a number of countries went back at a greatly devalued rate. It was, they devalued the currency and raised the price of gold denominated in their currencies. And they did that. It was a simple recognition of the fact that whatever the pre-war gold standard was, they had printed enormous amounts of money to fight the war. If you're going to go back to gold, you either had to devalue the currency to reflect the increased money supply, or you could decrease the money supply, but that would cause a recession. So they basically inflated their currencies and went back to gold at a new standard. That's why 1925 American expatriates like Ernest Hemingway and Gertrude Stein and F. Scott Fitzgerald were living very comfortably in Paris on relatively modest U.S. dollar incomes, because the franc was so devalued when they went back to gold.
Hello, welcome to the Wiggin Sessions. I'm Addison Wiggin. Today I have with me Jim Rickards, who is the author, as you know, of Currency Crisis and Death of Money. And I only mentioned those two. He's got a couple others, new Case for Gold and many other books. But I'm going to focus today on the dollar because it's heavy in the news right now. And Jim, I don't know if you know this, but you are now tied with the most honored guest presentations on the Wiggin Sessions.
Oh, I didn't know that. So good luck.
Welcome back.
Thank you.
And, what I want to do is, recently you were at Bretton Woods, the hotel at which the accord after World War II was signed that made the dollar the reserve currency of the world. You were at the hotel that gives the accord its name, the Bretton Woods Hotel, which is near Mount Washington in New Hampshire. You're speaking to us from Portsmouth, New Hampshire. I grew up in New Hampshire. We've got a good connection going there. I was hoping that we could walk through, for people that are unaware of what exactly the Bretton Woods exchange rate system was and what led to its demise in 1971. There's a lot of misconceptions, even among people who follow monetary history, and also gold bugs among us, who misunderstand how the exchange rate system worked and then what caused it to collapse. So I think a good overview of what it was, and then we can talk about why you were there in this past couple of weeks.
Sure. So I'd be happy to jump in on that, Addison. That's a big topic. There are numerous, 500-page books have been written on just facets of it, but we can summarize it and hit all the highlights. The first thing, a lot of people say, yeah, Bretton Woods, that was the agreement signed right after World War II. Actually, it was signed during World War II. It was done before the war was over. It created the system that prevailed after World War II, and that's why it was done. Even as early as the 1930s, scholars and policymakers had come to the conclusion that the Versailles Treaty in 1919 that ended World War I was one of the causes of World War II, because of the reparations imposed on Germany and inadequate attention to the international monetary system of the time. And one by one, at the beginning of World War I, this now goes back to 1914, countries suspended exports of gold, suspended convertibility of gold. They wanted to hang on to all the gold they could. They knew that gold would be crucial. Gold was money, in effect, and would be crucial in fighting and winning the war. So they weren't going to let any out of their hands. So the gold standard that had prevailed through almost all the 19th century, really back to the kind of the post-Napoleonic period in 1815, was abruptly ended with the outbreak of World War I. Interestingly, one of the biggest advocates for not ending it, at least in the UK, was an advisor to the Exchequer named John Maynard Keynes. Keynes is his reputation as this gold basher, gold hater, barbarous relic and all that stuff, which he never said, by the way. I actually tracked down the 1924 first edition of his works to see what he actually did say. And he was not talking about gold. He was talking about the gold exchange standard of the 1920s, which I would agree with Keynes was a very flawed system. But he argued strenuously in 1914 that the UK should not go off the gold standard. And the reason he said that was, he said, we're not going to win the war with money or with gold. We're going to win the war with credit. You're going to have to borrow a lot of money to do this. And if you suspend gold, you're going to destroy your credit. But if you maintain the gold standard, you'll maintain your credit and be able to borrow far more and fight the war. And that's exactly what happened. Jack Morgan, based in New York, raised enormous amounts of money for France and the UK, and raised no money for Germany, and that was one of the decisive factors. So now, kind of move ahead to the 1920s. One by one, countries had to rejoin the gold standard. Gold standard was voluntary. There was no IMF, International Monetary Fund, at the time, but that left them with a big decision, which is, what is the new exchange rate? There had been a pre-World War I, pre-1914 exchange rate. Each currency was pegged to gold at whatever that government chose. And they would obviously try to do something that made commercial and economic sense. But you joined voluntarily and you picked your own exchange standards, so to speak. Of course, once you pegged to gold, you pegged every other currency in the world, because not everywhere, but all the major trading currencies, because they're pegged to gold also. And France and Belgium and Italy and a number of countries went back at a greatly devalued rate. It was, they devalued the currency and raised the price of gold denominated in their currencies. And they did that. It was a simple recognition of the fact that whatever the pre-war gold standard was, they had printed enormous amounts of money to fight the war. If you're going to go back to gold, you either had to devalue the currency to reflect the increased money supply, or you could decrease the money supply, but that would cause a recession. So they basically inflated their currencies and went back to gold at a new standard. That's why 1925 American expatriates like Ernest Hemingway and Gertrude Stein and F. Scott Fitzgerald were living very comfortably in Paris on relatively modest U.S. dollar incomes, because the franc was so devalued when they went back to gold. The one exception to that was the UK. And at this point, we're talking 1925, Winston Churchill, believe it or not, was Chancellor of the Exchequer. It was long before he was Prime Minister, but he was the head of the Treasury, in effect. And he felt duty-bound and honor-bound to go back to gold at the pre-war exchange rate. He said that, a deal's a deal, a contract's a contract. People had faith in the paper money. Let's maintain convertibility at the old level. Well, he did that, but as I suggested, you had to cut the money supply in half to maintain the new peg. That put the UK in a depression 3 years ahead of the rest of the world. We typically date our depression in the US from 1929, lasted all the way to 1940. But the UK was well in depression as early as 1926. Finally, in 1931, they had a banking panic. They did devalue at that time. 1933, FDR devalued the US dollar against gold. There were all these dominoes that were falling. And of course, the bank failures, bank panics, reduced world trade, agricultural output, and the Great Depression. So, and this was considered not only bad in and of itself, but a contributing factor to World War II. Created so much imbalance and so much irredentism, and Germany's desire to, take back lands that it had given up to France and Poland and elsewhere, that it contributed to World War II. So here we were in 1944, before the war was over, but already Roosevelt, FDR, and Churchill were looking past the war and said, look, we can't let this happen again. We'll win the war. They thought they would win the war by 1944, but we can't let we can't win the war and then not have a good international monetary system. We'll repeat all the blunders and errors of the 1920s and be back where we started. So they convened the Bretton Woods Conference in Bretton Woods, New Hampshire, at the Mount Washington Hotel for that purpose of designing the system. Now, there were about 45 or so nations present. Believe it or not, the Soviet Union, which was an ally, of course, of the U.S. during World War II, was present. They ended up not signing the agreement, but they were there along with representatives of Canada and not the Axis powers certainly, but all the allied powers and South America, Brazil, and others. About 45 countries, give or take, altogether. An interesting footnote, but an important one. The lead U.S. delegate was the Deputy Secretary of the Treasury. His name was Harry Dexter White. The Secretary of the Treasury at the time was Henry Morgenthau, but he couldn't be there full time. He was in and out. But Harry Dexter White led the U.S. delegation. The U.K. delegation was led by John Maynard Keynes. And by the way, there were just, again, another footnote. The reason it was in Bretton Woods, New Hampshire, at the Mount Washington Hotel, and I was there. I've been there a number of times, but I was there most recently last week. It's in the middle of nowhere. It's absolutely beautiful. It's up in the White Mountains. Nice view. You're right in the foothills of Mount Washington. So it's a spectacular place, nice place to visit, but really hard to get to in the middle of nowhere. Well, why was it there? Oh, the answer is that at the time, John Maynard Keynes was not in good health. He was suffering heart problems, asthma, et cetera. And he was pretty close to FDR. And he said, look, you can't have this conference in Washington. Washington, anyone knows it, is built on a swamp. It's unbearably hot and humid in the summer, and air conditioning was not widespread at the time. And Keynes said, I'll die if you make me spend the summer in Washington. So FDR said, no problem. And turns out that a good friend of his was a senator from New Hampshire who owned the Mount Washington Hotel. So he said, we'll have it at my friend's hotel, high in the mountains, nice cool mountain air, be very comfortable. So there's nothing new about cronyism in Washington, D.C., but that's why they picked it, because it was a better climate for Keynes' deteriorating health. In fact, he died a couple of years later, so but maybe that helped him get through it. But the UK and the US were really the only important voices. And then the UK was really speaking for the entire Commonwealth. That's what gave it. And they had a fair amount of gold. That gave them a voice. But this was really all about the US hammering things out, compromising with the UK, and then coming up with something. And everyone else just kind of jumped on board. I'm sure there was give and take, but it was pretty much hammered out by the US and the UK. But in all fairness, it was really dictated by the US. Now, here's where it gets interesting, because Harry Dexter White was a Stalinist agent. And that might have been suspected at the time, but it was not really proven until the 1990s, after the Soviet Union fell and Russia under Yeltsin opened up the archives, and scholars were able to go in and prove it. So he was a Stalinist agent, and there were quite a few in the FDR administration. You don't have to be Joe McCarthy to understand that. And he was working on Soviet orders, and his orders were to come up with a system that would destroy the British Empire. And he did, because the Bretton Woods system, we'll talk about in a minute, actually did destroy the British Empire. And the reason was that a lot of people think that, again, this is one of the misconceptions you mentioned, that all countries link their currencies to gold. That was the global gold standard. That is not what Bretton Woods did. Bretton Woods pegged all currencies to the US dollar. And then the US dollar was pegged to gold at $35 an ounce. Now, by extension, or transitive law, if you want to use some sixth grade math, you were kind of pegged to gold because you were pegged to the dollar, and the dollar was pegged to gold. But technically, you were pegged to the dollar. That made the dollar the kind of global hegemonic currency, if you will, but also left the UK extremely vulnerable, because they had issued a lot of sterling, pound sterling notes denominated in sterling to the Commonwealth countries, Australia, Canada, India at the time was still part of the British Empire, et cetera. They were technically redeemable into gold, but there's no way that the UK had that much gold. It wasn't even close. But by diminishing the role of sterling and elevating the role of the dollar, it made sterling more vulnerable to runs on the bank, basically, which then fed into the whole independence movement in the 1950s. It wasn't the sole cause, but when India, I believe, went independent in 1947, and then throughout the 50s, the African countries, Singapore, one by one, they left UK. So it actually worked by undermining the dominant role of sterling and highlighting sterling's vulnerability to a run on gold. It exacerbated economic tensions with everybody, including Canada, Australia, and a lot of the African members of the Commonwealth. And it did lead to the breakup with the British Empire. So it's kind of mission accomplished for Morgenthau. But coming out of it, you did have a world where the only currency pegged to gold was the dollar, and everybody else was pegged to the dollar. Now, why did they do it that way? The answer was that they felt that other currencies might run into difficulties, trade deficits, imbalance of payments, et cetera, and might have to devalue. Now, they didn't want anyone to devalue. That wasn't necessarily the plan. But realistically, they thought it might happen. Again, that was one of the problems of the 1920s, 1930s, is that devaluing against gold was a total crack up. It usually came hand in glove with a banking panic, as it did in the UK in 1931. So they felt that if you could modulate that process, the dollar was always pegged to gold. That was the anchor of the whole system. But if you ran into trade deficit problems, there was a swing lender. The swing lender was the International Monetary Fund. That was really the role of the International Monetary Fund at the beginning. Now, throughout the 80s, 90s, and into the 2000s, it's become this like global monetary policeman. They impose all kinds of deals. They make loans. They made multi-billion-dollar loans to Ukraine a couple of years ago. Ukraine did not meet any of the criteria for a borrower, but obviously it was political. So the IMF has become like the finance arm of the U.S. State Department, and a highly, highly political organization, wandered very far from its original intention. But the original intent was that if you were in a little distress, the IMF could make you a loan of gold or dollars. Then that would buy time for you to fix whatever problem it was. Maybe you needed to lower your unit labor costs. Maybe you needed to create more efficiency, reduce regulation, raise taxes, whatever the case might be. You would buy time, and then you could get back on an even keel and keep the exchange rate. But sometimes that didn't work. Either it was politically infeasible, like, hey, we're not going to raise taxes, or, we're going to lose an election, or we can't squash wages because we'll have strikes. And we actually have to devalue. And when that happened, you could do that. There was a process. You would devalue against the dollar. Now, indirectly, you were devaluing against gold, but the dollar gold peg was the anchor, and you would devalue against the dollar. So the IMF was a swing lender, and it was a forum for discussing terms and conditions of devaluation, if that's what it took. And of course, the famous crack-ups were the devaluation of pound sterling in 1967, and again in 1974, and there were others. But that was the process. So, and they created two other organizations. One was the World Bank, which was for developing economies, not the developed, where they were supposed to lend to encourage development in what today we call emerging economies. Back then, probably would have called it the third world. But they were to help the poorest countries. And then there was something called the General Agreement on Tariffs and Trade, which later became the World Trade Organization. And that's a multilateral organization for negotiating reductions in tariffs whenever possible, but also protections of intellectual property. And also it's in appeals or an adjudication process. If you think somebody's cheating under the rules of the WTO, you can bring a case to the WTO, and they have some clout. They can impose sanctions or penalties, and or you put tariffs on my jets for no good reason. I win the case. I can put tariffs on your wine, whatever it might be. So you really had three Bretton Woods institutions: the IMF, the World Bank, and was now the World Trade Organization. IMF was the swing lender. The World Bank was for poorer countries, the World Trade Organization was to reduce tariffs and encourage world trade. A very, very ambitious set of organizations. By the way, they're all still around. We're off the gold standard, have been for a long time. We'll talk about 1971, Nixon, and closing the gold window and all that. But all three of those institutions, the IMF, the World Bank, and the World Trade Organization, are all still around, all important, all fairly powerful. So that was the deal. It was signed in July 1944, so we're just past the, I guess at this point, 78th anniversary. And as I say, they're still in existence. Now, through the 1950s, this worked fairly well and into the 1960s, but by the mid to late 60s, it started to break down. And the principal reason was that the U.S. never had enough gold to cover all the dollars. Now, under a classic gold standard, you don't necessarily have to have that. The Austrians would bang the table and say you have to have 100% gold, et cetera, but that's not true. In the 19th century, the Bank of England ran a successful gold standard with about 20% coverage. Until the end of World War II, the U.S. ran a gold standard with 40% coverage. Then we lowered it to 25%. Then we abandoned the gold, what's called the gold cover ratio. We abandoned it completely in 1968 during the Vietnam War. That was the whole guns and butter crack up under LBJ, under Lyndon Baines Johnson. But even as early as the 1960s, you could see what was happening. In 1950, so and just after World War II, beginning of the Bretton Woods era, the United States had 20,000 tons of gold. By 1970, we had 9,000 tons of gold. Where did the 11,000 tons go? Well, the answer is 3,000 to Germany, 2,500 to France, 2,500 to Italy, 600 to Japan, et cetera. And as we had all these trading partners, and the way the system worked at the time, if you ran a trade deficit, that meant you got their stuff. So we were buying transistor radios and Toyota cars and Sony TVs and French wine and taking vacations in Switzerland. But that meant all those dollars were going overseas. And those trading partners who had these dollar surpluses could cash them in for gold. And they did. And we sent them the gold. And that was how the system worked. But by the late 60s, a run on the bank had developed. A couple of things happened. One was there was a private market that was set up side by side with the official market. So the official market was $35 an ounce. The private market, it could be $40 an ounce, $41 an ounce. It wasn't wild. It wasn't $200 an ounce where it got to sooner than later. But even a couple of bucks was what traders call an arbitrage. It was free money. So what France could do, they could cash in dollars for gold at $35 an ounce, turn around and sell the gold in the market for $40 an ounce. That's practically risk-free, and you make an easy profit. And if you want to leverage it, you can make even more. And that was happening, but more to the point, countries are putting the gold in their vaults. So there came a time when Charles de Gaulle sent a destroyer to New York to pick up his gold to bring it back to France, with the under the auspices of the French Navy. So that was exhilarating. So and it was because there wasn't two things were true. One, there was never enough gold. It was all based on confidence. But two, the confidence was eroding because the U.S. ran massive trade deficits and budget deficits, the twin deficits at the same time. Now, there's a case for that. And this was kind of what the Marshall Plan was all about in a much smaller way. But as time went on, at the end of World War II, Germany was in rubble. Japan was in flames and ashes, but they were important economies, and we needed friends to face off against the Soviet Union. So it's very much in our interest to help those countries get back on their feet. Well, how could they do that if they didn't have any money, they didn't have any gold, they didn't have any credit? Well, they did have something, though. They had human capital. They had engineering expertise. They had been large industrial economies before the war. So what they really needed was some money and some credit. But you could extend that to them so that they could get manufacturing going. And then they paid it by exporting stuff. So again, around in the 60s, the Volkswagen Beetle was a popular item. Japanese transistor radios took them to the beach, et cetera. And so But that meant we, the United States, had to run trade deficits so that we could run a capital surplus, meaning we would have the capital to put into these countries. And they were the opposite. They ran trade surpluses, but had capital deficits because they were borrowing all this money. But it worked. It worked. It got the money around. And then, a little bit later, the petrodollar deal was just the ultimate extension of that in 1974. But the problem was confidence was eroding. People were like, how long is the U.S. going to run these deficits? What do they expect us to do? Pile up dollars forever? I mean, the Germans and the Japanese actually did, but the French, Swiss, and the Italians were not so sympathetic. And they developed a run on the bank, on Fort Knox, that the gold was going down fast. It was very clear that the gold was soon going to be depleted if Nixon didn't do something. So he got together with John Connally, who was Secretary of the Treasury, Arthur Burns, who was head of the Fed, Paul Volcker, who was not head of the Fed. This is 1971. Volcker was Deputy Secretary of the Treasury. So you had Volcker, but he probably knew the most about international economics. You had Volcker, John Connally, Herb Stein, very brilliant economist, Ken Dam, a friend of mine, was later dean of the University of Chicago Law School. And, I mentioned Arthur Burns and a few others. And they went to Camp David for the weekend, and they knew that they were going to have to devalue the dollar against gold. They knew that's where it was going to end up. There was just no way they could maintain the $35 because we were running out of gold. And I spoke to two of the people who were at Camp David that weekend, Paul Volcker and Ken Dam, I mentioned, and they both told me what scholars have said, but it was just interesting to talk to people who were there with Nixon. And they said they did not think it was the end of the gold standard. What they thought they were doing, this is what Nixon said. You can find the video clip on YouTube. It was August 15th, 1971. So we're just past the,
51, right?
So 1971. So we just passed, I guess, the 45th or 46th anniversary of that. No, that's not right. 71.
51st.
51st. Yeah, that's right. Because last year was the 50th. So we just passed the 51st anniversary of that. But they knew they were going to have to devalue the dollar. But what they said was that we are temporarily suspending the redemption of gold for our foreign trading partners. Now, Nixon used the word temporary. He said that in the speech, and it didn't even get a lot of notice at the time. It was in the same speech he had also announced wage and price controls. Can you imagine the president going on TV today saying, we're going to have wage and price controls starting tomorrow? And there were a couple other provisions, but the gold was third on the list. And it came at the end of the speech and everyone was like, whatever. And of course, Nixon did the usual. He said, by the way, this will have no impact on the dollar in your pocket yesterday is the same as a dollar in your pocket tomorrow. You still go spend dollars and have a good time. That was only true if you were spending them in the United States. And of course, it opened the door to inflation, but they always say that. But they said, we're going to have another Bretton Woods conference, and we're going to devalue the dollar to some new level to be negotiated and devalue the dollar against other currencies, which they did. That conference took place in Washington in December of 1971. It was called the Smithsonian Accord or the Smithsonian Agreement because that's where they had some of the meetings. They did devalue the dollar from $35 an ounce to $42 an ounce, which is a 20% devaluation. They actually did everything they said they were going to do, except for one thing. They never went back to convertibility. Now, saying the dollar was now worth a different amount in gold is a bookkeeping exercise, but we never went back to a system where foreign trading partners could cash in dollars for gold. And there were some reasons for that. One of them was Germany had what would have been about the strongest currency in the world at the time, but they were trying to honor Bretton Woods. They were trying to maintain this peg to the dollar. There was no euro at the time. It was the Deutschmark. But they were trying to maintain a Deutschmark dollar peg, which is what Bretton Woods said you were supposed to do. But unlike the British and the French who had devalued, all the pressure in Germany was to revalue, basically to make it stronger against the dollar because they ran these trade surpluses and they had really good products and engineering. So Germany was in effect selling their own currency to suppress the price and buying dollars, but they were up to their eyeballs in dollars. And finally, they said, "We're just going to go to a floating exchange rate. We're going to let the market figure it out." And of course, the Deutschmark soared immediately, which devalued the dollar, which is what we were trying to do in the first place. So, so one by one, countries went on the floating exchange rate. So by the time you got to December, this was all over the course of 1971, some before and some after August 15th. But by the time you got to December 1971, it was kind of over. A lot of countries had gone to floating exchange rates. Milton Friedman advocated it. He was wrong for a lot of reasons, but he was the big voice of the time. It seemed to work okay. And everyone's like, yeah, what's with this gold standard? What's with fixed exchange rates? Let them float. And if your country's in distress and you got to cheapen your dollar, cheapen relative to the dollar, let the market do that for you. Or if the dollar has to devalue, let the market do it for you. We don't need the IMF turning the dials, and we don't need fixed exchange rates. So they never went back. Interestingly, I got my graduate degree in international economics in 1973. Now everyone says the gold standard ended in 1971. That's not quite right. Nixon did suspend redemptions in 1971. That's right. But it took a couple of years for the IMF to demonetize gold. I mean, at the time when you joined the IMF under the Articles of Association written at Bretton Woods, you had to pay like a quota, a membership fee. Well, not a fee, but you had to invest in the IMF. You could give them a certain amount of local currency, but not much, a certain amount of dollars and gold. You had to actually have some gold to join the IMF. That's why the IMF ended up with thousands of tons of gold, and they still have over 1,000 tons of gold to this day, which is a lot. But by 1973, that had changed. So 73, 74 was the end, the real end of gold as an international monetary asset, even though Nixon had suspended redemptions in 1971. But when I was in graduate school, we studied it. We had to study gold as a monetary asset. And I was the last class that did so. I always say, if you're younger than I am and you know anything about gold, you either went to mining college or you're self-taught, because they literally stopped teaching it in universities, and they don't to this day. But my professors, so I was like a 25-year-old grad student, my professors were in their 50s, but they were the young guns of Bretton Woods. Like when they were in their 30s, they were running the Bretton Woods institutions at some level throughout the 50s and 60s. So I was being taught by the people who actually created Bretton Woods. And I carried that with me ever since. Maybe that's why I'm so interested in it. But I did get trained in that. Unlike today, they don't even. You can maybe take it in history class, but you don't learn it in economics. So where are we today? The Bretton Woods institutions are still around. The World Bank kind of does what it was always supposed to do. The World Trade Organization is bigger and more powerful, but it does what it was supposed to do. The one that's changed the most is the International Monetary Fund, because we don't need swing loans for deficit problems anymore. You just devalue your currency. But they do make loans, usually that are highly political, highly selective, and they do kind of work around the edges of global financial crises, but that really falls back on the Fed and the other central banks. So we're still in an age of Bretton Woods, but we're not in an age of gold.
Currently, we're going through a financial crisis. The Fed is trying to deal with inflation. We're speaking now just before the Jackson Hole annual meeting of the Federal Reserve and central bankers in Wyoming,
right,
where they get together and they talk about these very topics, like how do we manage a floating exchange among currencies. And this year has been interesting because across all Western economies, we've seen massive inflation with 40-year highs since the early 80s, where the inflation that was kicked in after Nixon and after the exchange rate system fell apart, we had a period of inflation that was, Paul Volcker was credited with raising interest rates to cut that down. But we've witnessed, even in 2008, the financial crisis in 2008, and currently we've witnessed the dollar rally and become like a safe haven asset. During most times when the financial markets are working or they're benefiting from very low interest rates, the dollar is not yielding anything in terms of savings. But in times of crisis, the dollar continues to rally as people pull out of stocks. Maybe the stock market's going down and they can get up to, say, 4% yield just holding cash. That is still a feature of the Bretton Woods system, even though most currencies are floating against other currencies. But when the proverbial crop hits the fan, we see that the dollar continues to rally as the reserve currency. That's a curious thing to say, even in light of the Russia-Ukraine war, where Russia is looking for a way to trade their natural resources, gas and oil, in rubles, and making deals with like India and China and even Saudi Arabia outside of the dollar-based system. So I'm curious to hear your thoughts on why it is that the dollar rallies when we enter into a financial crisis, and just kind of break it down in simple to understand terms, because it's a complex issue in the first place. And then a lot of people aren't aware, like, how can the dollar be rallying in an inflationary period? Like, if we could break it down, it has something to do with it being the reserve currency, but it's also that there's sort of a race to the bottom. Other fiat currencies are also under duress during these financial crises as well.
Well, okay, let's unpack that a little bit. I'll answer all that, but you got 4 or 5 moving parts. So let me just kind of highlight them a little bit so we can address them separately. The dollar generally does rally in a financial panic. That's correct. And it does so because people want the best assets they can find. They're like, the best description I've ever heard of a financial panic is everybody wants his money back. It doesn't matter what you're in, get me out, sell it, whatever. I want dollars. Well, when you get the dollars, you got to go buy something. So you can leave it in the bank, but banks are risky. I mean, the problem in 2008 is the banks were failing, and that didn't quite happen in 2020, but it absolutely happened in 2008. So they buy treasury bills. They buy treasury notes. They're the safest assets. They may not want them for long, but you can buy a 2-year treasury note or a 6-month treasury bill. You're not in it that long, and your money's safe. So there is a demand for dollars somewhere around the world to buy that really good collateral because it looks like a safe haven relative to everything else that's falling apart. That's not exactly what's going on today, but it's related. We're not in a global financial panic right now. We may be heading for one. We talked about that separately. We're not in one right now. We are in a recession. The U.S. is definitely in a recession right now. We had 2 consecutive quarters of decline in GDP, first quarter, second quarter. Well, that's a recession. We'll see what the third quarter is going to be, but it may be prolonged. It may get worse. Europe is in a recession, just based on the latest data. Japan is in a recession. China looks like they're in a recession. They reported their most recent growth figures of 0.4% for the second quarter, not 4%, but 0.4%, versus compound growth of over 10% for about 30 years. So, and they lie. So if they're admitting 0.4, then I have to believe that's negative. So we're really looking at a global recession. Now, a recession or even a depression, which it may turn into, is not the same as a financial panic. You can have panics without recessions. We saw that in 1998, 1987. You can have recessions without panics. We saw that in 1990 and 2020. Sometimes they do go together. 2008 was an example of both a severe recession and a severe financial panic. But I would keep those separate, because if we're not in a global financial panic, then we don't necessarily have dollar buying because of get me out of everything else. Although I want to come back to that. But we are in a recession. Now, the recession should damp down the inflation. It hasn't yet. Inflation's high. There's no question about it. We see it in the data. You see it at the gas pump. You see it at the store. But that may trend a lot lower very quickly, but not for good reasons. In other words, you say, well, what's the Fed doing about inflation? Well, they really can't do anything about it. The inflation is coming from the supply side. The inflation can come from probably a lot of places, but two places in particular, supply side and the demand side. Supply side inflation is when there are shortages, there are bottlenecks, there are supply chain dysfunction, people run out of stuff, there's not enough fertilizer, not enough water, not enough truck drivers, ports are clogged, you can't get the input A to make item B, so you got to shut down assembly line because you can't get titanium from Russia to build Boeing aircraft. It's complex. It's huge. It's the subject of my next book, Sold Out, which is coming out in November. But supply chains are breaking down in many different respects, and prices go up as a result. But that's not. But the other kind of inflation is called, and it's called cost push inflation. The other kind of inflation is demand pull inflation. This is when consumers change their behavior. They get it in their heads like, hey, prices are going up. They're getting out of control. I better go out and buy that thing, And this is what we lived through in the 1970s. And I remember very well. If you were going to buy a refrigerator, a new car, a dishwasher, whatever, you'd say to yourself, I better go buy it today, because if I wait 3 months, it's going to be higher. Or 6 months, it's going to be a lot higher. So of course, that just pulls demand forward. And it creates excess demand relative to supply, and then prices do go up, and it feeds on itself. Next thing you know, bosses are handing out raises because of inflation, people just spend more, et cetera. So the Fed can do something about demand pull inflation. They can destroy demand by raising interest rates, raising mortgage rates, credit card rates, and everything else. They can't do anything about supply inflation, the supply chain inflation, cost push inflation. They can't do anything about it. The Fed doesn't drill for oil. The Fed doesn't drive a truck. The Fed doesn't run a cargo line. The Fed doesn't mine, titanium in Russia. They can't do anything about any of those things. So, then you get into, is it really inflation? Well, inflation means prices are going up. But if they're going up for that reason, two things are true. One, the Fed can't do anything about it. Two, it will probably run its own course in the sense that, if prices go higher, there's going to be a lot less discretionary income. You still got to put gas in your car, and you still got to put food on the table. If those two things have doubled in price, and they have, then you have that much less left over for everything else. You'll say, well, I'm going to skip the vacation, skip the concert, skip the restaurant, skip a lot of things, new furniture, whatever. I'm not going to buy any of those things because all my money is going to buy gas and food. So you still get the gas and food, but not more. You just pay more, and the value of your dollar goes down. Real wages go down, and you're not spending money on anything else. That'll put the economy in a recession real fast. That's happening. We're in a recession. I already said that, but it will get worse. Now, here comes the Fed, right? Always a day late and a dollar short, or maybe too many dollars, but they always get it wrong, is my point. So what are they doing? Well, they're saying inflation in the numbers. They don't really seem to distinguish between supply side and demand side. And they're going to the Volcker playbook: raise rates, raise them, raise them, raise them, raise them, raise them. That can get inflation under control, but only at the cost of a much worse recession, higher unemployment, business failures, people out of work. I say, who cares what the price of gas is if you're sitting home unemployed because you're not buying any gas? So that's one way to get gas prices to come down, is just stop buying it, because unemployment goes up to 10%. And that's kind of what we're looking at. The idea of soft landing, forget it, not even close. The evidence is already there. Now, let's get back to the stock market.